Mortgage defaults in Ontario and BC are rising like a hockey stick, with some regions seeing catastrophic 45% price drops, and the pain is just getting started for secondary mortgage lenders. Good evening and welcome to the Daily Brief Canadian Macro. I'm Steve. Today we're telling one big story, how stress is building across the Canadian financial system, how it connects to a global economic shift, what institutions are doing about it, and most importantly, what you can do about it as an investor. Ron Butler breaks down the surge in mortgage defaults and power of sales. Over on the Loonie Hour, Ben Rabidoux joins the three amigos to put things in historical context as Canadians are hit with the steepest housing decline in 40 years. Steve Van Metre connects Canada's pain to a global stagflation contagion spreading toward America. Mark Mitchell unpacks what central banks are really saying and why you shouldn't take it at face value. And Minority Mindset closes us out with practical wealth building strategies for navigating all of this. Let's start on the ground. Ron Butler released striking data on mortgage defaults across Canada, and the picture isn't pretty. Defaults and power of sales are surging, but the risk isn't evenly distributed. Butler is clear that the six big banks are largely insulated. Their capital reserves are deep enough to absorb losses of $100,000 to $300,000 per property without meaningful impact. The real danger is concentrated among alternative lenders, private lenders, alternative institutions, and mortgage investment corporations, which account for roughly 40 to 45% of these defaults. Specific regions are seeing what Butler calls catastrophic price drops of 35 to 45%. Brampton, parts of Niagara, Oshawa, Northern Pickering, and Ajax in Ontario. At those lost levels, secondary mortgage lenders can't recover. Some mortgage investment corporations are already gating withdrawals. Private investors are losing everything on secondary mortgages. Some firms, Butler warns, will go bankrupt. That's the ground level picture. Ben Rabidoux zooms out to show just how historically significant this moment is. On the Loonie Hour podcast, Ben Rabidoux joined the three amigos Steve Soretsky, Richard Diaz, and the boomer Keith Dicker to put the current downturn in context. And the context is sobering. Canada has no unified housing market right now. Some metros are still posting 10% annual gains, but Southern Ontario is down 30% or more from peak, representing what Rabidoux calls the steepest decline in 40 years. National house prices are now showing negative 5-year returns for the first time since the 1990s, meaning homeowners renewing their mortgages may literally owe more than their home is worth. Rental markets are also softening nationwide as a wave of new rental supply hits at the same time the non-permanent resident population growth is slowing. On timing, Rabidoux is specific. Toronto and Southern Ontario single-family markets should start tightening in 2026 as inventory declines, while Vancouver won't see that shift until 2027. Slowing single-family construction in the hardest hit areas could establish market bottoms in those regions, but we're not there yet. This is a Canadian story, but Steve Van Metre argues it's also a preview of what's coming globally. Steve Van Metre has been watching stagflation move like a contagion, and his read is that Canada and UK were first, with America next in line. American consumers are already expressing serious anxiety about their paychecks and incomes, what Van Metre sees as an early warning signal. He expects retail sales to plunge as that anxiety translates into reduced spending. But beyond the consumer side, he's flagging stress in credit markets more broadly. UBS recently gated investors on a private credit fund for 3 years, a sign of liquidity problems that echo what Butler is seeing in Canadian secondary mortgage markets. Van Metre's framework describes a dangerous cycle. Declining sales lead to stagnant inventory, which causes loan collateral values to collapse. And taken together, the retail slowdown and private credit stress set up what he sees as the conditions for the next major financial crisis, not just in Canada, but globally. Which raises the question, what are the institutions responsible for managing all this actually saying? Well, Mark Mitchell had some thoughts. Mark Mitchell's focus is on central bank communication, and his message is essentially don't trust it. His argument is that central banks use messaging and policy to reallocate resources and shape behavior, not to serve citizens objectively. The contradiction he highlights is stark. In 2021, the Bank of Canada defended letting the housing bubble grow, framing surging prices as change preferences rather than the consequence of 0% interest rates. Now the bank's deputy governor is saying house prices must fall for affordability, even though prices are nominally where they were 5 years ago and significantly lower in real inflation-adjusted terms. Mitchell's point isn't just that central banks change their tune, it's that every interest rate decision takes from one group and gives to another, making central banks inherently adversarial to some portion of the population at any given time. His practical advice? When industry insiders cite the Bank of Canada to justify a position, treat it like a car salesman's pitch. They're trying to influence your behavior. So what should you actually do with your money right now? Minority Mindset closes us out with some grounding perspective. With all this uncertainty in the air, minority mindset brought it back to fundamentals, and the fundamentals are more powerful than most people realize. Investing just $100 a month for 45 years at a 10% return builds over $1 million through compounding interest. Bump that return to 13% and the same $100 monthly becomes $2.8 million. The math is unforgivingly in your favor if you're consistent. Their approach centers on passive investing through broader market funds, VTI for total market exposure, SPY for the S&P 500, QQQ for the NASDAQ 100, rather than trying to pick individual winners. The key habit they recommend is what they call always be buying. Set up automatic, weekly, bi-weekly, or monthly transfers into your investment account so you're dollar cost averaging without having to think about it. They're direct about day trading. It's a proven losing proposition for most people, even when markets are rising, because markets don't go straight up. And if you're only working with $100 a month right now, their first piece of advice is to focus on earning more before optimizing your investment strategy. Get the income up, then put the surplus to work consistently. The real key here is the consistency. If $100 a month is tough, try 50 or 20 or 10, but consistently contribute something to your future financial success. Today's analysis tells a connected story. It starts on the ground in places like Brampton and Fraser Valley, where secondary mortgage lenders are being wiped out by 35 to 45% price drops. It scales up to a national picture where Canada is experiencing its steepest housing decline in 40 years and negative 5-year price returns. It connects to a global stagflation contagion that's already hit Canada and the UK, with the US looking increasingly vulnerable. It runs through institutions, central banks that are actively shaping narratives in ways that don't always serve the people listening, and it lands on a simple, durable truth. Consistent passive investing, compounded over time, remains the most reliable path through volatility for the average investor. The system is complicated. The response doesn't have to be. Well, that's today's brief. All credit goes to the creators featured today. Their original videos are linked in the description below, and I encourage you to check out their full analysis. If you found this video helpful, please subscribe, hit the notification bell so you don't miss tomorrow's brief, and don't be afraid to comment if there's another creator you think deserves a highlight here. I'm Steve, as always. Nothing here is financial advice. Everyone's situation is different, so please do your own research and talk to a qualified financial advisor before making any investment decisions. Good night.